Well, thank you guys so much for attending. And I know I've known Matt for quite some time, and I try to help out with what I can with his business, and but I love entrepreneurship. Entrepreneurship is kind of one of my passions, and so I always look at and I see throughout this chat, there are quite a few LLCs, and so I'll talk about the some entities and stuff like that. I'm only licensed in Illinois and Missouri, so please understand that if I talk about anything, most of this is I'm going to be talking about general tax rules, which you can so that is federal, but then I'll also kind of talk about generalities about corporations and partnerships and all that fun stuff. Um, uh, First thing I always talk about, got to know where you're going before you truly get started. You got um, Michael Gerber, who wrote E-Myth, in his new book called Beyond E-Myth. Uh, One of his first phrases right out the gate is he says, you got to know your exit strategy before you enter into any kind of business. And I think that's always poignant to know is what is your exit strategy? Are you building this business to exit? And how are you exiting? Are you just going to use it and continue to use it until your death, or you scaling it to the level of um, uh, a level to eventually sell it? And I think that's the most important question for you when you first get started. We'll definitely talk about S corporations and stuff like that here in a second. But I always have certain criteria with regards to you know um, with regards to entities and things of that sort. I always quite is this your primary occupation? Is this something that you're passionate about, that you're looking to grow it? If you're looking to grow it, we um, and is it that side hustle that you're kind of doing a little bit of, a couple hours at a time, and making just a little bit of money, or is this something that you're doing as a full-time occupation? If this is a full-time occupation, we need to take steps to protect it. So and ensure that you can keep that separate from yourself. In any type of entity, whether we talk about LLCs or corporations, um, uh, you know, um, the question is, what are those entities? And truly, if you look at those entities, um, they are separate and apart from yourself. They're almost like a kid. They need money. They need all the you know they need all the extras, and they need your attention. Sometimes a lot, sometimes just a little bit. So so it all depends. But so if we so that it doesn't matter if it's a corporation or an LLC. That's it's basically its own separate entity. Sole proprietorships are, the positives of a sole proprietorship, where you don't file anything, is that there's not much structure, and you can start the business and close the business. You can start the business today, say, hey, I'm going to start my business today, and then close it tomorrow. And that's the benefits of a sole proprietorship is it's open, and it's still ongoing. Partnerships, Partnerships, basically what it means is there's more than one person acting as a sole proprietor, and you're working together. The problems with a partnership is you've got you're working with another person, um, and that partnership will be established, and it also can close down fairly quickly. Um, so definitely, um, there, the positives with a partnership is you've got more resources, you've got more people, you've got more you can work with somebody else, and um, combine your assets, have somebody else contribute to um, to the business. Um, but sole proprietorships and partnerships, they fail to get four main things, and that is um, limited liability. So if a sole proprietorship or a partnership is ever sued, you are personally on the hook, and all your assets are personally on the hook for any of those issues. There's no continuous life with sole proprietorships and partnerships. So if you die, your business also dies with you. Whereas an LLC or S corporations, they are ongoing and continue on. Um, uh, so if you are scaling the business to sell, and you pass away, that business can keep on going and operating. Um, so uh, uh, where whereas a sole proprietorship and partnership die with the person as they go. No, with sole proprietorships and partnerships, there's no centralized management structure. So um, sometimes you don't need a management structure, but giving authorization to each person is very important. And then being able to transfer those assets. Um, uh, you have the ability to transfer those assets um, if it's a LLC or corporation. So those are the four basic things that we always talk about, whether it's an LLC or C corporation or S corporation. Um, you know, those are all definitely the four main points to any kind of entity. Okay, so then we talk about in sole proprietorships, partnerships, S corporations, C corporations, you can be taxed under LLCs. You can be taxed in four different categories. You can be taxed as a sole proprietorship. You can be taxed as a partnership. You can be taxed as an S corporation, or you can be taxed as a C corporation. So LLCs typically give you a lot of flexibility and how you want to be taxed, and that's pretty consistent throughout all the jurisdictions, where you can use an LLC to elect to be taxed a different way. So sole proprietorships, the main problem is with sole proprietorships is what I call the line. And if you go through a normal profit and loss, and I'm just going to be very, very generic with this. You have your revenue at the top minus your expenses, and then whatever is left is your profit. The positive with that profit is, or the sole proprietorship is, whatever is left is your money, which is great. But if you're a sole proprietorship in the state of in the United States, everything that in that sole proprietorship, every dollar that's in that profit margin, you've got to pay self-employment tax on it. So you got to pay federal income tax, state income tax, but also self-employment tax. And self-employment tax, so if you've ever worked at a job, you see like FICA or Medicare or Social Security being withheld from your payroll tax. And a lot of that is, so you've got that tax, and the problem with that is you got to pay all self-employment tax. If that profit is less than about $105,000, that's a major problem. And the reason why I say less than $105,000 is anything above 105 and below 400,000, which is going to be a new category coming up. There is no tax between those two categories. But anything less than that, and say if you made $50,000, you'd have this tax. Reason why I talk about S corporations a lot is because you can move that line, and anything below in an S corporation, anything less than any of that profit margin becomes a shareholder distribution. And shareholder distribution is not considered to be active income. It is considered to be passive investment. So anything active would be up on the top. And the difference is on anything passive, you don't pay self-employment tax on. So, but with S corporations, you are required to pay yourself a reasonable salary, and yes, that passive is very, very good. So we want to make sure as much of our, a lot of our investment is passive. But with that, so that's the difference between S corp. If I was, I'm an S corporation as well. So I have a clear divide between what is payroll and what is distribution. And so if I have this payroll, I pay myself this payroll, and then I have this distribution, this payroll is taxed, and you have to pay the self-employment tax. So say I have $50,000 worth of, I'm a sole proprietorship, I've got $50,000. I want to save myself a little bit of income, and you're set up as an entity, so you've got an LLC. If you elect to be an S corporation and say, okay, half of it is payroll and half of it is half of it's payroll, half of it's distribution, I just saved myself about 15% in taxes between those two by making an S election. Now, it's not always good for all individuals. Please talk to your tax professional about making that election, because once you make that election, it's extremely hard for you to go backwards. So I always look at LLCs as kind of this continuum. Sole proprietors is kind of basic entity. Then you can either be a partnership, which is very close to sole proprietorship, just means that you got more than one. You can be an S corporation, or you can be a C corporation. Once you go this direction, it's extremely hard to move backwards. There's a lot of rules making that changing that election from C corporation to S corporation, from S corporation to sole proprietorship. very, very difficult. So make sure you have those individuals, um, accountants talking to it. So let me look through these questions. What would you be paid if you went to work as an entry level position as an evaluator? I think you can get away with so $50,000 or less. So if you're, if you, and that, yeah, Matt, you're right on with regards to reasonableness. So think of reasonableness as what would somebody else pay you to do your job. So if somebody else paid you, $40,000 or $50,000 to do that same job, you can do that, and then that would be considered to be reasonable. So if your profit margin, if your true number is $100,000 and you pay yourself 50, you'd have $50,000 worth of income. So with an LLC, there's different forms and different ways of setting things up. Under LLCs, typically you're seeing members and managers. And there's really not a board of directors per se. LLCs came into being in the late 90s and really have taken off because a lot of people didn't like the formality of everything with regards to corporations. They wanted some flexibility built in. So with corporations, you've got three areas of management. You've got the shareholder, you've got the board of director, and then you have the officers. So you've got three levels of management. See, in Illinois, there's a lot of taxes and a lot of fees. So when I first established my business, LLCs were not very cheap. They were very, very expensive. So I set myself up as an S corporation, and as a true corporation. And so, but what a single individual, so if I look at my management structure, I'm the sole shareholder, I'm the sole board of directors, and the sole officers of the organization. So you can be all three at the same time.
Couple questions here that I want to make sure you get.
Yeah.
Let's see, where is it? Carlisle asked Todd, remind us how to set up an LLC paying taxes in an S corp. And I get that question from time to time, and I go because I'd never even heard of that until I started talking about corporations, which is probably why I shouldn't be doing it here today, Todd. Anyway, so if you could share a little bit about this hybrid LLC S corp idea.
Okay, so with LLCs, to be taxed, to be LLCs, you can make that election to be an S corporation. So when you first form an LLC, you're considered to be what's called a disregarded entity. For tax purposes, that's what the IRS considers you. So they will consider you, if you've got two people, then you're considered to be a partnership. If it's a sole individual, you're considered to be a sole proprietorship right out the gate. So you have to make two tax elections in order to be to get yourself from what's called a disregarded entity, being taxed as a sole proprietorship or a partnership, to over into the S corporation method. And there's two forms. I think it's been a while since I personally have done it. I usually just say, hey, Jennifer, go take care of this. So I think it's an 86. I'll tell you here in a second. I think it's an 8832. Yeah. So, and it's an IRS form 8832. So you're an entity making classification. And any of that stuff is going to be, again, I would have an accountant handle that. If they view looking at your taxes, this would be the best entity. If you know, typically within the first year, sometimes even the first 2 years, you've got more losses on your entity than you have gains. You know, like you're investing a lot in marketing, you're investing a lot in setup costs, you're buying computers, you're buying equipment, and you've got a lot of things that you're spending a lot of money on. That first year, maybe even 2 years, you may be upside down and you may show a loss afterwards through either depreciation or anything else like that. So, you know, a lot of times the accountants will say, I don't want to be taxed as an S corporation the first year or two because of that reason. So I usually, it's now my firm's policy that we'll set you up. We may not elect that first year to be taxed as an S corporation based upon those circumstances. So we got to figure out from a tax perspective if that's a loss. LLCs offer, I think it depends with regards to asset protection. I think it depends on the states. Most, if you know, Delaware, you know, I haven't heard anything in Illinois. I haven't heard anything in Missouri. Nevada's pretty good. Wyoming's pretty good. LLC states. You know, most states, it's LLCs are just as good as corporations. I haven't heard of any state that I'm concerned with for an asset protection. The question really becomes is, are you treating that LLC like an LLC, or is it your own little piggy bank? And that's the question that really jams a lot of people up with regards to asset protection and LLCs. Anytime you're commingling assets within an LLC or something like that, you know, you're paying your personal house bill, you're paying anything personal out of your company that's not considered to be a reasonable business expense, then you do have a risk of them breaking apart your LLC. And that doesn't matter if it's an LLC or a C corporation. You know, there's a lot of laws on the books that say if there is commingling or you've undercapitalized your business, basically you haven't put enough money for it to survive, then yeah, I mean there's concerns. B corporations. Matt, I think you sent me that, and I can't.
I can answer this question. This is
Yeah, go for it.
this is one that is probably a little bit more specific to our field. A B corporation is not actually an IRS designation. You would set yourself up as an LLC or an S corp, or I think you could even be a sole proprietorship. It is a designation that you get through a separate entity. It's kind of like getting accreditation. at a university or for an academic department, you would be identified as a B Corp, and then and what that does is it sets you up for certain kinds of contracts when you're working with nonprofits and government organizations that have a preference, a bit like becoming identifying as a women-owned or a minority-owned organization. In this case, you give so much of your profits back into the community, and I haven't looked into it too terribly close, but that's what a B corporation is. But you actually are still taxed as an S corp or an LLC or whatever you're set up with the IRS, and that's what that is. That one got thrown at me, and I was like, okay, that's a new one. I don't know that one.
Yeah.
Oh, see, Kelly just put up a bcorporation.net. There you go. There was a question, and I haven't read it all. Maybe you did, from Claire. Todd, you want to take that one?
Yeah. So, Matt, I mean, this is do you foresee any kind of from evaluation and research? Do you see any type of liability risk?
Yes. Oh, yeah. Great question about the liability. I'm glad that was brought up earlier. I'm going to start this off. I'll let Todd finish it. Your liability insurance isn't going to cover being sued because somebody got harmed because of your evaluation. If they take your advice from your evaluation and they implement it and they lose $100,000 or whatever, that's not going to cover you. That covers you for when you're at a conference and somebody trips over your extension cord, and that's what that covers. You need professional liability insurance. And most people don't get professional liability insurance until they get that quote unquote big project. And it's usually with an organization that requires it. And so if you're in education, you want to look at AERA, the American Educational Research Association. Aside from that, you can look at brokers. And it's unreasonably expensive for what we do. And no, I have never heard of anybody getting sued. Though if you go to AEA, you will hear people talking about that. I'm sorry, Todd, go ahead, hit the rest of the insurance from your perspective.
Yeah, I mean, the risk is something, I'm not aware of, but with LLCs, I mean, by establishing yourself as an entity, as long as you're doing the corporate formalities within a business, they can't shoot through the corporation, and that's called piercing the corporate veil. So if you're sued from somewhere else, they can't shoot through the corporation, and there's a little barrier. In some jurisdictions, this is important to know, under LLCs, they can't from you go up into the corporation, which is kind of like a reverse piercing. So if you are personally in a car accident, not to say that anybody would do this, but if you were drinking, driving, and you end up killing somebody, and somebody sues you, and you've got this entity, they can't. There are ways within the operating agreement to almost do what's called a reverse pierce and try to get the assets within the LLC. But there are great statutes that are available depending upon your jurisdiction that may be able to protect you from that. So that's one of the positives with LLCs, sometimes more so than corporations, is to avoid that reverse pierce. With that, kind of the fun technique, they call it a changing order, asking for funds or asking for assets away from the corporation, and we've had the opportunity to say, okay, well, you're suing an LLC, we'll pay you the income, or we will give you the taxable distribution of income, and they have to pay the tax, but they don't get the money. So I distribute and say, well, the corporation did a great job this year. It had $100,000 worth of income. You are now the owner of the LLC, but we're not distributing any of this money. So you get to pay the taxes on the $100,000. And a lot of people don't like that. So they do not typically try to pierce the corporate. They do what's called the reverse pierce unless, and unless your operating agreement doesn't provide for that. So that'd be a good thing. And a lot of like those legal Zooms and stuff like that don't offer those protections that an attorney may be able to provide. So I'm a big believer in do it yourself as much as possible. But sometimes, in things, you do want to have an attorney evaluate those things. So, all right. How about setting up a C corporation? No. Simple answer. Absolutely, positively not.
Double taxation, right?
You've got double taxation. So we talked about, real quick, we talked about, this dichotomy with self-employment tax with C corporations. So we go back to that line. You have the income, you've got the expenses, whatever's left, we have a profit. So in that profit, you pay corporate rate federal state income tax on that profit, which is great, but corporations are right now they're taxed at a fairly decent level, but in the future they'll be taxed significantly more. And then if you want to pull money out from there, you got to pay another tax called capital gains tax. So you're hit twice with taxes. Once on the profit and once as a consideration as a dividend. So if you buy IBM stock and they pay you out a dividend, you're taxed, or the IBM is taxed first on the corporation income, and then you got to pay taxes on that dividend. So it's not a bad deal if you're just paying the dividend, but if you got to pay both sides, then you got a problem. So the simple answer is no on C corporations. I've never had a scenario where I would want to be taxed as a C corporation. Best friend and I want to set up a 50-50 partnership. Is this a good idea or bad idea? Do you want to, the question I have back is, you want to remain friends? If you don't want to remain friends, then this would be an awesome idea. But if you want to remain friends, it is an awful idea. Your view of a partnership, their partnerships don't last very long. In my experience, I've had partnerships in the past. They're okay. You got more resources, but there's always a risk with it, because if you have two different directions and things of that sort, there's always a risk, because but I also do believe that you got to have a visionary and an implementer in your organization. A visionary casts the vision and understands and is looking to the future, and is looking 5 to 10 years in advance and anticipate what the changing market's going to be. And then you also have to have this implementer, the guy that will go in implement the policies and procedures that need to be taken care of in order for you to expand your business. So with any kind of organization, you need two people. And the question is, do you hire that person to be that implementer, or do you bring them in as a partner? And you just have to have clarity anytime you have a partnership. But 50-50, I would never recommend. I would recommend that somebody has the ultimate authority. So it would be a 51-49 partnership, where if the buck stops at where somebody has the authority to say, nope, that's not the vision, that's not where we're moving, and somebody can vote that way. If you have 50-50, problem is that will end up in court, because the only person that can break a tie is a judge, and attorneys are expensive, so you got to have somebody to break that tie. Yeah.
I was
Matt,
just supporting your statement about if you've set up a 50-50 partnership and you do all the work, you still got to give 50% of the revenue or the profits. When you take profits, you take $10,000 out, you got to give $10,000 to your partner. And if they're not holding their weight, it's going to be a bitter check to write. That's another reason. Yeah. Question, here's one for you. What's your take on profit sharing versus giving stock options? Or none of the above?
To motivate a key employee, or?
Yeah. So you bring somebody in, you're like, we're in this together. I own the business and all, but I want to show that if you work real hard and we get this business up and running, you're going to get something more than just your base salary.
If they're helping you along, I would say some kind of profit sharing, where it's clearly defined. But you get into, the question is it a policy, and you have multiple people within your organization that you're offering it. So, is it a one-time deal? I had a COO until last year, where we said, hey, I'll give you 10% off the top of the organization, or off of our profitability. And that's always typically one of those things that I'll give them a percentage. I think, but it's very, very clear this is how we determine profitability. If it's a profit, and then profit sharing, I mean, you start getting into, okay, is this, are they entitled to a percentage of the business, or are they entitled to shares? And that may be that may be your exit strategy. Maybe that's how you want to set it up. So there's a lot of varying, and I think it's a person to person scenario. So. Yeah, I mean, Jason, good question with regards to, it says about paying yourself a reasonable amount. Is it okay to turn on and off payroll as business takes in? Absolutely. I mean, you're the sole person. It's not, you don't have to determine what that reasonable salary is until either a quarter or until the end of the year. So you got, you just got to make sure you got enough, you're doing enough withholdings throughout the year to cover yourself. So, especially if you're getting started, it's extremely hard to determine, okay, can I pay myself? Can I not pay myself? How is this all working? So. but it just varies. So. Pam asked the question that I had an LLC with two others, dissolved in December. We're still friends. We never had much money in there. Now want to do my own. I assume I start from the beginning and keep the same name. You know, if the other two are willing to let you just take it over, Pam, you know, then they just sign off on their shares. So, you know, maybe that's the way to, you know, and maybe you reestablish yourself, reestablish it with that name. Typically, most states, I think there's like a 2-year window where you can't use that same name for 2 years unless you've got consent. So if you re-up it, you know, that might be a positive instead of just dissolving it, so long as the other two are okay with that. So it just varies. Kelly's got one. I keep payroll at an acceptable minimum, automate bi-weekly. Business is good. I pay myself a dividend, makes record keeping, withholding easier. Yeah, yes. That's a great strategy, Kelly. You use that strategy, you know, pay yourself kind of a baseline salary enough just to get by. So if you've got these peaks and valleys within your organization, you know what your constant money is going to be, and that way you can keep your bills paid and you've got an expectation. You got to be, you know, you got to treat this business as if it was your employer. You know, so if you're running short on money, you got to hustle. If you've got flush in cash, you can bonus yourself out. You know, just make sure that you've got enough money within your business to maintain that even level. So,
what do you think about what are some of the strategies for setting up your corporation or your LLC to be sold, which is kind of an anomaly in our business? No, you don't really hear about that very often. We have one case where we have Gomani Lindquist, who was with us it was either late November, early December. She buys consulting firms, and so I never really got to talk to her about that. And I'm gonna sort of answer this, but I'd love for you to kind of react to what I say. My thoughts are, Todd, that I'm setting up another checking account inside of my company, and I call it my Profit First checking account. I did a session on that where 10% of my revenue I set aside in there, and hypothetically it's going to grow and grow, and I'll have that as a rainy day fund, but it'll also demonstrate my company's profitable and everything doesn't just go straight out the door. Is that an effective way to demonstrate my business is profitable and could set me up for a potential sale?
yes. Right. So at any point in time, so let me kind of go back a little bit and talk about, you know, the difference between what you want your accountant to do is get you to zero so that you pay $0 in taxes. I mean, that's ideally everybody's strategy is, I want to write off as much as possible and have zero taxes that I got to pay. You want to sell your business, that's not going to be a good strategy. And you've got to get into a routine. If you are at that $0, it causes a lot of, I mean, there's a lot of problems with that, because if you're always hurting for cash and you're paying money out and distributing it and paying, you know, you're not profitable. that's a problem as well. So we always want to make sure that we are profitable. The whole point of the business is to be profitable, and it's okay to pay taxes. I say that with a grimace, but it's okay to pay taxes, and show profitability, because you never know when that is going to take place, when that sale has to take place. Uh, we set up our businesses and we're running and running and we're running this office, and then all of a sudden somebody passes away unexpectedly. Do you want to take over that business? You can get a quicker sale if you have it profitable. Um, so that's always important, to set up a profit margin, but also plan for those expenses. I like that Profit First book. We're in the middle of working on that for my business, where we're establishing not only just the profit account, but also that reserve fund on all your expenses.
You keep a reserve. You keep the reserve inside of your business, or do you take it out and put it in your personal, and then you can infuse money if you need it? You have it either way. And I've been told the old 3-month rule of make sure you have 3 months of revenue. I mean, a lot of us are struggling and most of us can't get to that. But when you get to that point, that's where you want to try and get. Would you agree with that? And where would you put it, internal to your company or external in your own personal account, so that you can infuse it and have a little more flexibility?
So you always have, there's always, I was just having a conversation with an accountant today, and I've had conversations with other clients in the past. You have to, if you get too much money within your organization and you haven't distributed it out, you have the risk of somebody coming in and seizing those funds. But you also have the risk of those funds being seized the other way. So you're kind of at a catch-22 with regards to where do we keep the funds, and what, and we have to look at what's our risk. If we're generally a careful person, then your risk outside the company is probably less than inside the company, because there's always occasion where we have boo-boos, and make mistakes from a professional perspective. So there's always that risk, and if you have cash in the business, that cash is always at risk. You can always put it back in. There's no question about putting it back in. But if you're risky on the outside, you get a lot of speeding tickets. You play a lot of risks on the outside. Probably have way too many. I'm a speeder. You have liability risk on the outside.
If you see Todd coming in Edwardsville, we all pull over and get out of his way. Todd, we got just a couple minutes left, and I love to ask this question to people. From your perspective, is now a good time to start a business?
Today is probably the best time to start a business ever. When you see a crisis and there's people going down, all those people that were in business at the time, they are now struggling because they didn't have a pandemic plan. No one had a pandemic plan. So, you look out in the world, this is the greatest opportunity to get into business out of anywhere, because you've got all the downside risk has, a lot of the downside risk has been eliminated, and the people that were in business that were struggling or are exiting, which then opens your door to less competition. So You know, if you're in the, if you want to buy a hotel, given about 6 months, and this would be a great time to buy a hotel. You're wanting to buy a restaurant in about 6 months, this would be an awesome time to buy a restaurant. You know, just think about all the different things that are going down. There's still a need, but they can't keep it afloat, and they're probably willing to sell it at rock bottom prices right now because they want to get out, and they've weathered the storm and tried to weather the storm, and they're all exiting. So this is, you know, 08, 20, anything after 2020. I mean, these are, you know, buy low, sell high. That's a perfect strategy. So now is the time.
So I'm going to tell everybody when we send out this video, also keep an eye out for some information that I give to people at conferences on these topics in my own personal research that has not been reviewed by Todd. So if you do it and you get injured, you can't sue me or Todd. I'm just telling you right now, it's just my personal experiences. So take a look at it. No lawsuits about this, okay? I already disclosed we're doing profit first, so everybody's going to look to get in on my profit first, right? But I want to thank Todd for coming today, and I could keep you here for 2 more hours just asking you questions.
Anytime you give the floor to an attorney, we just babble on and on and on and on. So, you know, because we charge by the hour.
Yeah, exactly. Exactly. I know you guys do because I've paid a couple of those bills. Speaking of which, I think I'm going to forward you a lease agreement. You tell me if it's worth reading or not, but that's a wholly different conversation. But please, group, you register and take a look at the sessions coming up next week is Robert Hoke, and he's going to be talking about weathering the storm. Oh, I will say one more thing if you're still here. If you are in a position to hire, I got this from one of Todd's podcasts that he does from time to time. This is a great time to hire people because unfortunately, a lot of people are out of work. And so I hired an employee in a senior consultant in January, and she's fantastic, and she would not have been available in another situation. So I was very happy to do that, and I've got nothing but positive feedback on her performance. So Jason, I'll get back to you by email on our private conversation. Beyond that, I'll let everybody go, and we'll put this out there into the cyber universe for everybody to view at a later date.